Preparing for a FP&A Analyst at SSE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join SSE as an FP&A Analyst. I am an analytically minded finance professional who enjoys turning operational data into clear decisions. In previous roles, I built forecasts, investigated variances, and partnered with non-finance teams to improve performance. SSE appeals to me because it combines commercial discipline with a major role in delivering the net zero transition through renewable generation and electricity networks. I would bring strong Excel skills, curiosity, attention to detail, and the confidence to challenge assumptions constructively while learning the energy sector quickly. While answering, connect your finance experience, analytical strengths, stakeholder skills, and interest in SSE's energy transition, renewables, networks, disciplined investment, and purpose-led culture. Question 2. What does FP&A contribute to a business like SSE? FP&A helps SSE understand where performance is heading and what management can do about it. The team translates operational drivers, such as generation volumes, power prices, customer demand, project delivery, and network investment, into financial outcomes. It coordinates budgets, rolling forecasts, variance analysis, and management reporting, while challenging assumptions and highlighting risks. Strong FP&A is not simply reporting historic numbers. It connects financial information with decisions on investment, costs, capacity, resilience, and long-term shareholder value. Make sure to cover planning, forecasting, performance analysis, decision support, capital allocation, operational partnering, risks, and how FP&A supports both near-term delivery and long-term energy transition investment. Question 3. How would you build an annual budget for an SSE business unit? I would begin with SSE's strategic priorities and the business unit's performance baseline. Next, I would identify operational drivers, volumes, prices, headcount, maintenance, project milestones, financing costs, and regulatory assumptions. I would gather bottom-up submissions, challenge inconsistencies, and reconcile them to top-down targets. After consolidating the plan, I would run sensitivities around key risks, document assumptions, obtain approval, and establish monthly ownership so the budget remains a management tool rather than a static spreadsheet. In your answer, talk about strategic alignment, bottom-up operational inputs, top-down targets, driver-based assumptions, challenge sessions, consolidation, sensitivity analysis, approvals, and ongoing ownership after submission. Question 4. What is the difference between a budget, forecast, and strategic plan? A strategic plan sets the longer-term direction, investment priorities, and value objectives, often across several years. A budget is the approved financial and operational commitment for a specific year, providing targets and accountability. A forecast is the latest view of expected performance based on current information and can change throughout the year. At SSE, the three should link logically. Strategy defines direction, the budget translates it into annual actions, and forecasting identifies whether delivery remains on track. Be sure to mention purpose, time horizon, update frequency, accountability, assumptions, flexibility, and how the three outputs should connect without being treated as interchangeable documents. Question 5. How would you prepare a monthly management reporting pack? I would first validate actuals, prior period comparatives, budget, and forecast data, checking interfaces and unusual movements. Then I would produce a concise summary of revenue, costs, cash, capital expenditure, operating KPIs, and forecast variance. For each material movement, I would explain the operational cause, timing, permanence, and management action. I would tailor the detail to the audience, highlight decisions required, and complete a review with budget holders before distributing an accurate, visually clear pack. Focus on data integrity, actual versus budget analysis, forecast updates, KPIs, commentary, materiality, business drivers, risks, actions, and tailoring the pack to executives rather than merely presenting raw numbers. Question 6. How do you investigate a material budget variance? I start by confirming that the variance is genuine and correctly classified, then split it into price, volume, mix, timing, foreign exchange, and one-off effects where relevant. I compare actuals with budget, forecast, and prior year, then speak with the responsible operational manager to understand the root cause. Finally, I assess whether the issue affects the full-year outlook, update the forecast if needed, and communicate both the explanation and proposed action clearly. Mention materiality, decomposition into price, volume, mix, and timing, source data checks, stakeholder discussions, root cause, forecast implications, corrective action, and concise communication to decision makers. Question 7. How would you forecast revenue for a renewable generation business? I would build revenue from operational drivers rather than apply a simple growth rate. The model would include expected generation, resource conditions, plant availability, curtailment, contracted volumes, merchant exposure, achieved power prices, and relevant balancing or certificate income. I would distinguish committed assumptions from market-sensitive ones and create base, upside, and downside cases. Each month, I would reconcile forecast generation and prices to actuals, investigate deviations, and refresh the full-year estimate. In your answer, cover generation volume, weather and resource assumptions, availability, outages, contracted versus merchant exposure, power prices, balancing costs, hedging, scenario analysis, and reconciliation to actual performance. Question 8. How would you forecast operating costs in SSE's networks or generation businesses? I would separate costs into fixed, variable, controllable, and committed categories. Headcount, salaries, inflation, maintenance schedules, contractor rates, fuel or balancing requirements, outages, and regulatory obligations would form the main drivers. I would validate assumptions with operations and procurement, phase costs according to delivery plans, and distinguish timing shifts from genuine savings. I would also compare unit costs against history and operational metrics, because a favorable expense variance may simply reflect deferred maintenance or delayed investment. Be sure to mention fixed and variable costs, inflation, headcount, maintenance cycles, outages, contractor rates, regulatory requirements, procurement assumptions, phasing, and links between operational plans and financial forecasts. Question 9. What KPIs would you monitor for SSE in an FP&A role? I would select KPIs that explain both financial outcomes and operational drivers. Financial measures could include revenue, EBITDA, operating cost, cash flow, CapEx, net debt, and forecast accuracy. Depending on the business, I would also track generation volumes, plant availability, achieved prices, outage days, customer metrics, project milestones, cost per unit, safety performance, and emissions indicators. The key is to avoid a long dashboard. Each KPI should support a decision, reveal risk, or explain performance. Discuss financial, operational, project, cash, and sustainability measures, including EBITDA, operating costs, CapEx, generation, availability, safety, project milestones, leverage, and emissions-related indicators. Question 10. How would you assess a capital expenditure variance on a major energy project? I would compare actual and committed spend with the approved cost breakdown and project progress. I would identify whether the variance reflects timing, inflation, procurement changes, scope growth, contractor claims, design issues, or a genuine cost overrun. I would then review the estimate at completion, remaining contingency, delivery schedule, and cash profile with the project team. Finally, I would quantify any impact on returns, funding, milestones, and the wider capital plan, escalating promptly when thresholds are exceeded. Focus on approved business case, committed and uncommitted spend, procurement, construction progress, schedule, scope changes, contingencies, cash phasing, completion cost, and impact on returns and funding requirements. Question 11. How would you build a business case for a new renewable energy investment? I would begin by confirming strategic fit and defining the investment scope, capacity, timing, and commercial structure. The model would forecast development, construction, operating, financing, decommissioning, and working capital cash flows. I would use realistic assumptions for generation, availability, power prices, contracts, inflation, taxation, and funding, then calculate NPV, IRR, payback, and value sensitivities. I would present downside cases, delivery and market risks, mitigation actions, and clear decision gates rather than relying only on a headline return. Mention strategic fit, development and construction costs, operating assumptions, power price scenarios, subsidies or contracts, operating life, financing, NPV, IRR, sensitivities, risks, and governance approval. Question 12. What is NPV, and why is it useful for SSE investment decisions? Net present value is the present value of expected future cash inflows and outflows, discounted at an appropriate required return. It shows whether an investment is expected to create value after considering timing and risk. For SSE, NPV is useful when comparing long-lived projects competing for capital, such as renewable generation or network infrastructure. I would never present it without sensitivities, because power prices, construction costs, delays, operating performance, and financing assumptions can materially change the result. Explain discounted future cash flows, time value of money, discount rate, value creation, comparison of alternatives, assumptions, limitations, and the importance of sensitivity analysis in long-duration infrastructure projects. Question 13. How would you explain the impact of interest rates on SSE's financial outlook? Higher interest rates can increase borrowing and refinancing costs, raise discount rates, and reduce the present value of long-term project cash flows. They may also affect customer affordability, regulatory returns, pension assumptions, and the economics of new investment. The impact depends on fixed versus floating debt, hedging, maturity profiles, inflation linkage, and regulated frameworks. I would model direct and indirect effects, compare scenarios, and distinguish near-term cash impacts from valuation or accounting effects. Cover borrowing costs, discount rates, project valuations, customer or regulatory effects, inflation linkage, hedging, refinancing, cash flow, leverage, and scenario analysis rather than assuming one uniform impact. Question 14. How would you approach cash flow forecasting? I would build a rolling cash forecast using operational assumptions and known payment schedules. Operating cash would incorporate earnings, working capital movements, tax, and exceptional items. Investing cash would reflect project milestones and procurement commitments. Financing would include debt drawdowns, repayments, interest, and distributions. I would reconcile the forecast to the balance sheet and prior actual cash, challenge timing assumptions, and run downside cases to assess liquidity headroom and funding requirements. Include operating cash drivers, working capital, capital expenditure, financing, tax, dividends, timing, committed payments, liquidity headroom, scenario analysis, and reconciliation between profit forecasts and cash outcomes. Question 15. What working capital issues might an energy company face? An energy company can experience significant working capital volatility from customer collections, supplier payment terms, commodity settlements, collateral requirements, inventory, and timing differences between generation and cash receipts. I would monitor receivable days, overdue balances, payable days, collateral movements, and cash conversion alongside operational drivers. I would investigate whether changes are structural or temporary, partner with commercial and treasury teams, and ensure actions preserve supplier relationships and customer outcomes rather than improving cash through unsustainable delays. Discuss receivables, payables, collateral, commodity volatility, inventory, settlement timing, customer collections, supplier terms, contract structures, liquidity, and how finance can distinguish sustainable improvement from timing benefits. Question 16. How would you improve a forecasting process that is consistently inaccurate? I would first measure forecast error by business line, account, horizon, and driver to identify whether the problem is bias, volatility, timing, or poor data. I would replace unsupported percentage adjustments with driver-based assumptions, assign clear owners, standardize input templates, and introduce review checkpoints. I would compare each forecast with actual outcomes, capture lessons, and use ranges where uncertainty is high. The goal is not perfect prediction, it is a transparent forecast that improves decisions and accountability. Mention forecast error analysis, driver-based modeling, ownership, assumption governance, cadence, system improvements, scenario ranges, bias detection, feedback loops, and balancing precision with practical effort. Question 17. Describe a time you used data to influence a business decision. In one role, monthly overtime costs were rising despite stable headcount. I combined payroll data with production schedules and found that a small number of teams were routinely covering late shifts caused by planning gaps. I quantified the cost, tested the analysis with operations, and recommended changing shift allocation rather than simply reducing overtime approval. Management adopted the change, and overtime fell over the following quarter. The experience reinforced that finance adds value when analysis leads to an operational action. Use a concise STAR structure covering the business question, data sources, analysis, validation, recommendation, stakeholder communication, decision, and measurable result or lesson learned. Question 18. How do you ensure accuracy when working with large Excel models? I use a consistent structure separating inputs, calculations, outputs, and supporting data. I avoid hardcoding where possible, label assumptions clearly, use checks for balance and completeness, and reconcile key totals to source systems or the general ledger. I test formulas with reasonableness checks and alternative calculations, maintain version control, and ask for peer review before distribution. For recurring models, I document ownership and refresh steps, while considering automation when manual spreadsheet risk becomes material. Be sure to mention structured inputs, formula discipline, controls, reconciliations, version management, independent checks, documentation, peer review, protection, and awareness of spreadsheet limitations. Question 19. What would you do if an operational manager challenged your variance analysis? I would listen carefully and ask the manager to explain which assumption or data point they disagree with. I would revisit the source, definitions, timing, and calculation rather than defending my first conclusion. If I made an error, I would correct it openly. If the analysis remains valid, I would explain the evidence and acknowledge operational context. We would agree the root cause and action together, documenting any assumption changes so the forecast and future reporting remain consistent. Focus on listening, fact-finding, shared definitions, evidence, respectful challenge, correcting errors quickly, separating facts from assumptions, agreeing actions, and preserving the relationship while maintaining analytical independence. Question 20. How would you prioritize competing deadlines during a month-end and forecast cycle? I would map deadlines, dependencies, stakeholders, and consequences, then prioritize activities affecting statutory reporting, executive decisions, cash, or major investment commitments. I would complete high-risk data collection early, use a checklist, and agree realistic timelines with budget holders. Where conflicts arise, I would communicate the trade-off promptly, seek help, and delegate repeatable tasks appropriately. I would not sacrifice key controls for speed. Instead, I would simplify low-value analysis while protecting accuracy and review time. Mention materiality, regulatory or executive deadlines, dependencies, effort versus impact, early communication, task planning, controls, escalation, delegation, and protecting quality on high-risk outputs. Question 21. What are the key differences between regulated networks and renewable generation from an FP&A perspective? Regulated networks typically operate under frameworks that determine allowed revenue, investment recovery, incentives, and returns, making regulatory assumptions and delivery performance central to forecasting. Renewable generation is usually more exposed to resource availability, power prices, contracts, curtailment, construction risk, and operating performance. Both are capital intensive, but their revenue certainty and key sensitivities differ. FP&A must therefore tailor models and KPIs rather than apply one approach across SSE's networks and energy businesses. Discuss revenue frameworks, allowed returns, volume and price exposure, capital intensity, regulation, project development, operating drivers, risk profiles, and different performance measures across the businesses. Question 22. How would you evaluate the financial impact of a delayed wind farm project? I would quantify the revised construction schedule first, then rephase CapEx, debt drawdowns, interest, operating costs, and the start of generation. I would assess lost or deferred revenue, contract penalties, inflation exposure, tax effects, supplier claims, and any impact on grid connection or incentives. I would update project NPV, cash requirements, and the full-year forecast under several completion dates. I would also identify mitigations, such as resequencing work, and clearly separate timing effects from permanent value destruction. Cover delayed revenue, revised CapEx phasing, financing costs, contractual penalties, inflation, generation timing, tax, cash flow, NPV, stakeholder impacts, mitigation, and updated completion scenarios. Question 23. How would you communicate bad news in a forecast to senior management? I would communicate the issue early, clearly, and without softening the facts. I would state the expected impact, explain the operational driver, distinguish confirmed information from uncertainty, and show the effect on budget, forecast, cash, or strategic milestones. I would provide downside and recovery scenarios, outline management actions, and identify the decision or support required. Senior leaders do not need every spreadsheet detail, but they do need a credible view of magnitude, timing, accountability, and options. In your answer, emphasize early escalation, factual clarity, quantified impact, root cause, confidence level, scenarios, mitigation, ownership, and avoiding surprises while remaining calm and solution-oriented. Question 24. What finance controls are important in FP&A reporting? Important controls include reconciling reporting data to the general ledger or approved source systems, restricting access to sensitive models, maintaining version control, and documenting assumptions and changes. I would use review checklists, independent checks, approval evidence, and clear ownership for submissions. Segregation of preparation and review is valuable for material outputs. Controls should be proportionate, but they must prevent unauthorized changes, detect errors quickly, and provide an audit trail for management decisions and external scrutiny. Mention data reconciliations, access controls, approval workflows, version control, segregation of duties, assumption sign-offs, audit trails, review evidence, materiality thresholds, and timely correction of errors. Question 25. What would success look like in your first 6 months as an SSE FP&A analyst? After 6 months, I would expect to understand SSE's business drivers, reporting calendar, planning processes, systems, and key risks well enough to operate independently on core deliverables. I would have built trusted relationships with finance and operational stakeholders, produced accurate reporting on time, and contributed useful variance explanations and forecast improvements. I would also aim to identify one practical process enhancement, while demonstrating integrity, collaboration, curiosity, and a clear commitment to supporting SSE's net zero ambitions. Be sure to mention learning the business, building relationships, delivering reliable reporting, understanding drivers, improving processes, meeting deadlines, adding insight, and demonstrating SSE's values through collaborative behavior. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.